Rates Live with the Mortgage Calculator. Today we're going to go through some live rates and then do a deep dive into down payment assistance programs. Give us a few minutes here to go live on all the different platforms. We are streaming on YouTube, Facebook, Instagram, and LinkedIn. So just a moment here and we'll get started. In the meantime, we did put the chat up on the screen, so feel free to drop a comment there in the chat as you tune in. Good morning, everybody. Good morning to everybody already commenting. Adam, Mark, good morning. Happy Friday, everyone. We'll get started here in just a moment. Good morning, everybody there in the chat. All right, looks like we are live on all the different platforms, so we can go ahead and get started. We'll take the chat off the screen. And welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do on this show every morning is pull up the live mortgage rates for different programs. And then we do a deep dive into a different topic every day. And today's topic is going to be down payment assistance programs. A lot of misconceptions about down payment assistance programs. And, definitely a lot of knowledge to share here. So our sales manager, Jose Gonzalez, with 27 years of experience as a loan officer and a realtor, has definitely a unique perspective on the down payment assistance programs, dealing with them on both sides of all the transactions. So he's going to get into a deep dive into that in a little bit. But before we do that, let's go ahead and pull up our pricing tool to go over the live rates for today. So Nick, let's go ahead and see what the market is looking like this morning.
All right, let me switch my screen and we will get started. So as Kyle mentioned, this is our pricing tool for our mortgage professionals. This will show us the general rates and APR, including all the fees for today. It is July 21st, just after 11 a.m. Eastern. So all of our general programs have some new live rates issued. If you'd like a full loan estimate with an itemized breakdown of all the fees that go into the APR, please get with our team members. We have over 300 licensed loan officers, and we're licensed in 24 states for primary and second homes. And we can do our business purpose DSCR, which we love, in 44 states. Now for the demos today, we always set up a scenario so that we can compare across the programs, apples to apples, and compare the APR. So we're going to set up our general scenario here with a $400,000 loan amount. We're going to set the LTV to 80% loan to value, 20% down payment. We'll set the desired price to 99. That means we're going to ask the computer to find the best rate at one discount point cost, which is a typical request. We're going to compare our different loan types here. We're going to start with conforming conventional. Then we'll check out our FHA programs for today. Then we'll go into expanded guidelines, also known as non-QM, where we have over 5,000 additional programs using alternative income. And we don't do VA or USDA live. Remember, VA is only for eligible service members and veterans. If you do happen to be eligible, let us know. We'll quote it in just a couple minutes. Same with USDA. Not everybody is shopping in a USDA eligible area. If you are happen to be shopping in a rural area that qualifies, let us know, and we can quote it in a few clicks. For the first quote, though, today, we're going to start with conforming conventional. We'll do a purchase, 30-year fixed loan, primary occupancy, single-family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos today, we use an estimated FICO score of 760 and an estimated debt-to-income ratio of 40. So let's see what the rates are this morning. Just a touch higher than yesterday. So that's why we love to do this show. Watch the movement here. 6.99 rate for 0.875 discount points and costs. Puts us at a final APR just a little over 7 at 7.153. Remember, the APR takes all the costs into account. So this allows us to compare across different loan programs. Now, if there's any reason that our customer doesn't qualify for conventional, typically the next option we're always going to go to for the same scenario is an FHA program. FHA does allow a little more leniency on some of the credit items, as well as a much higher debt to income ratio we can use. So let's check out the FHA options today. Looks about the same as it was yesterday as well. 6.125 rate, 0.875 discount points and costs, puts our final APR at 6.713. So in this case, and as it has been for the last few months since all the changes with FHA, for our customer that qualifies for both programs, FHA is actually a little bit cheaper here at 6.713 APR compared to the 7.15 that we had for conventional. So definitely recommend our customers qualify for both. Check out both. And our customers that have to go with FHA, you're in luck with those recent changes that have lowered this pricing a little bit here. So some great options there. Now, where we really love to specialize at the Mortgage Calculator is if our customer has trouble qualifying for any of the conventional or FHA programs. Many other banks or lenders don't have other options, but that's where we specialize with our expanded guidelines non-QM programs that allow us to use alternative income. So everything else will stay exactly the same, but you notice a new option pops up here for our non-QM where we can select a different income option. So full docs, what we use for conventional and FHA, that's 2 years of tax returns. So typically we'll choose a non-QM program to select one of these different options, like our asset-related programs, business bank statement programs. Our investment programs are only for investment properties. We'll talk about that in a minute. Our personal bank statement, 12-month, the most popular program by far. We also have RSU, stated income, VOE, 1099, P&L, and the CDFI no ratio programs as well. But the most popular is our 12-month bank statement for our self-employed borrowers. Many times when self-employed borrowers submit 2 years of tax returns, they may have various write-offs and may not qualify at all, or may not qualify for as much income as they really need for the home they want. So in this case, instead of using tax returns, we'll simply use their last 12 bank statements, no tax returns involved at all, to determine a debt to income ratio of 40% in this example, while using just their cash in the bank, no tax returns involved. So most self-employed borrowers qualify for double, triple, quadruple the income, and therefore can qualify when they won it before and solve their problems. So these non-QM programs we love to use to solve those challenges. Obviously, the rates are going to be a little bit higher here, but let's check out the options. So the best option at the top here, 7.5 rate, 2.125 discount points and cost, a little more cost here, puts our final APR at 7.604. So remember, compared to conventional at 7.15, we're right there, just a little bit under half a point difference in order to use a completely alternative income method. So these programs are amazing, especially when they're very comparable to our conventional options. Now you'll see we have a ton of different ways we can use this, different programs that allow us to use bank statements. Some of these programs at the little bit higher rates may allow things like credit events, such as foreclosures and bankruptcies, that would otherwise disqualify us for the standard programs. So we love to get these non-QM programs and use them to solve income problems, but also guideline issues as well. So please get with our team. If you're having any issues, we'd be happy to solve those problems. Now, before we go into Jose's DPA examples, we always want to do some live rates for investors. So if we set the occupancy to investment property, we'll set up the LTV to the same as all our other demos here, and we're going to compare our investment property options, which we have two. We have conforming conventional, and then we'll check out our non-QM expanded guidelines options. Remember, the government programs, FHA, VA, and USDA are not eligible for investments. So for the first example here, we'll select conforming, and the only thing we've changed here from our other demo is the occupancy to investment. So let's see what the conventional programs have added for investment properties. Ooh, a little bit more than it was yesterday here, but a good option here for a good rate, 7.125 rate, but notice the discount points, 4 discount points and costs. And that puts our final APR at 7.392. So this is a good option. However, most investors ask us to go for a little bit higher rate in order to reduce the discount points here. This is, in this example, $16,000 is a lot of money that our investor would rather spend elsewhere, or most investors would. So unfortunately, with conventional, there are really no higher rate options to lower the discount points. There's a couple options down here, but we really run into those issues with the recent changes to the conventional programs. So to solve that problem, our final demo here, we'll set up investment, 80 LTV, and we'll check out our non-QM options, which will allow us to solve that issue. So when we do a non-QM investment property, we have a few options that pop up. First, the income, of course, and the most popular income option for an investment property on non-QM is going to be our investor DSCR option. It's also our most popular loan by far because it doesn't actually require any income or employment. We simply use the estimated rental income from the property to determine a DSCR value, stands for debt service coverage ratio. If the estimated rents can cover the expenses, the PITIA of the mortgage, aka the property cash flows on a monthly basis, that's a ratio of 1.00 or higher. The property makes money monthly. We even have options for a DSCR ratio under 1.00, which would mean the property doesn't quite cash flow on a monthly basis. So we have a ton of options. For our demo, we'll always put 1.5, which is the max, so we can see all the different options pop up. And the final thing we need for a non-QM investment property is a prepayment penalty, which is standard. 3 years is always standard for these programs. There are some options that allow 0, but that will cost more and limit the amount of options. And we have some options for 5 years that will cost less and save our customers some money, but not all programs allow it. So for the demo, we always select 3 years since that is the most common. So let's check out the DSCR options this morning. So the option at the top here, 8.125 rate for 0.725 discount points and costs. So we saved our investor nearly $13,000 in this example that they can deploy into another investment. So our investor's happy as long as the property cash flows. And a final APR at 8.182. So a little bit higher rates, obviously, but most investors, when they're presented both options, I'd say 90+% of investors, when they presented with a conventional option versus these DSCR options, will choose a DSCR for the flexibility, no income, no employment, much quicker, much easier. And most importantly, for our experienced investors, they can do multiple loans at the same time to cash out multiple loans, to purchase multiple new properties, and get a lot of flexibility here. Also, if we scroll down here, there's a ton of different DSCR options with different variations. Some of these may allow foreclosures and bankruptcy and other credit events. Some of these may allow things like short-term rental income to be used, obviously at a little bit higher rate there. So tons of different options. We do a ton of different shows on this, so please check out some of the past episodes for all the different variations here. Now, let me go ahead and prepare to pass it over to Jose for our example today. So very different from the investment properties we just went over are our down payment assistance programs. So we did a couple trainings this week for our MLOs, for our MLO training. Obviously, this one is geared towards the public here. So we're going to talk a little bit more about what it actually means rather than the structure here. But we have a ton of different options for down payment assistance. A lot of people love the idea. We went over really in depth on our trainings there about the differences. So please get with your loan officer so that they can explain those differences. But Jose, why don't you introduce the topic a little bit for the public out there, and then we'll go through your example. So let me make it big, and then we'll go ahead and pull up your screen.
Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Great to be with you here today. Down payment assistance, definitely a topic where there are a lot of misunderstandings, right? Because everyone thinks that when they think of down payment assistance, they're thinking more of the municipal or the state programs where you have to qualify based on income requirements. Basically, you got to have very low income in order to qualify, because those programs tend to offer a second mortgage that no repayment is due, which is usually a large percentage of the transaction. It could be 30%, could be 40% of the actual cost of the property. That is going to be a second mortgage that doesn't have to be repaid, and which is going to require the borrower to remain in the property for a certain number of years for it to continue to be a non-repayable option, right? Those programs are also for first-time home buyers, right? And tend to be more local in nature. meaning in order to be able to originate that loan, you're going to have to be more in that local market because they're going to be, you have to apply as a loan originator. So not only does the borrower have to apply for the program and go to certain classes, stuff like that, but they're also going to, the originator is also going to have to apply to the program and abide by the requirements of that program. What exactly does that mean? Well, that means that there's certain maximum compensation requirements that are going to have to be met, and that means that those same compensation requirements, you as a company would have to abide by them on in the rest of your operation. So what that means is that if, for example, that program states that the maximum compensation that you can make is, as a company, is 1.5%, then across the board, you would have to make 1.5% total. Right? So that does place challenges on what you can do as a company. You would have to change your whole operation, which is the reason why those types of programs tend to be more difficult to handle when you are a national company rather than a localized company, because compensation laws, and this is federal lending laws, do prohibit that from being possible. So the examples that I'm showing here today are more for the national version DPA, where you're not restricted by those compensation requirements, and also where the borrower is not restricted by having to be a first time home buyer, nor are there any income limitations on this product. So it is a much more user friendly product for both the borrower, which is our main concern here, and also for the mortgage loan originator to be able to viably be able to offer that option. On the localized option, it's a very small pool of borrowers that are actually going to be able to benefit from that program, because not only are there the first time home buyer restrictions and the income limitations, but also the money has to be available. And what usually happens in these programs is that there's a long waiting list of borrowers that have applied and are basically just waiting in line for the money to be available. They're in order of acceptance, right? And as soon as money becomes available, it gets distributed by the order that they've been waiting, and it usually does not last to be able to be given to everybody that's waiting. So you could be waiting for a long time. And besides that factor, those types of programs tend to also take longer to close. It is usually governmental type agencies that are administrating it, and their goal really is not to operate as efficient as possible. It's just to meet the requirements of the program. So you're going to add usually at least 30 days processing time to your transaction, which could add further obstacles that you may have to meet if you are in a tight inventory market where the sellers and the listing agents may be requiring shorter period closings, maybe 30 to 45 days, or if you can get a maximum 60-day closing on a contract, that would be amazing. But usually it's going to be 30 to 45 days, what will be accepted when you're putting your offers out there for the seller to accept. So a lot of challenges that are posed by the localized program that can be offset by going with the national program, and most of the borrowers would be able to benefit then, and actually being able to purchase a house, purchase a property using the DPA program. So the example.
So for our examples today, these are all the national examples. We do have the local, but those are very challenging, and obviously we can't present those on a national show because only a small amount of borrowers will ever qualify for those. Correct?
Correct. Yes,
Okay.
sir.
All right.
So the examples I'm giving today are all purchase examples. You can do rate and term refis with this program, but really DPA is for DPA. Why would you use it if it's for a refi? So here we're looking in the first example is a forgivable option. Now this is the preferred option, and let me make that a little bit bigger for you all there. Okay. Now this is the preferred option because it has the best of both worlds, right? It's forgivable, minimum 620 credit score. Now this program can be combined with either FHA or USDA loans. It cannot be combined with a VA loan, and it cannot be combined with a conventional loan. That's very important to note. FHA or USDA. So the examples I'm giving are for FHA because FHA doesn't have any location type restrictions like USDA does, but just note USDA is possible for this program. So here, this is a 3.5% assistance. So in our example here, the assistance is for $15,750, which would happen, is the exact amount of the down payment, but it's basically applied to the transaction expenses lumped together. Your transaction expenses being the down payment plus the closing costs. Now, obviously, if you're lucky enough to be able to combine this with some seller contribution, depending on the market you're in, there are no restrictions in doing that. This does not limit the borrower in being able to negotiate additional types of concessions like that. This is just allows you to, if you were needing this amount of money, not to have to resort to having to get a seller concession for the closing costs or nothing, right? Because we all know very tough to get seller concessions also in these very tight inventory real estate market when you're competing with multiple offers for the good properties. So with this forgivable option, it is forgiven after 60 months, no payment is due, and no interest accrues either, right? It's forgiven after 60 months if the first mortgage is current. Now, if the borrower has had a history of late pays, 60, 90 days, stuff like that, you may run into an obstacle there. So they do really want the loan to be current. So this favorable option allows for the borrower not to, also very important point, the favorable pricing on this option, which has always been another stumbling block for the DPA program, for the national DPA programs currently, with the crazy volatile pricing we've had in the market. Well, this program has very favorable pricing, which does allow for the borrower not to pay a broker fee out of pocket. We can actually include the compensation within the pricing of the rate. So very good option here. But you will notice, obviously the rate is a little bit higher than what you would have seen Nick just provide for the FHA loans, which are in the high sixes, maybe very, very low 7 if you have like a really bad credit score, but typically in the high sixes where you can buy them down. But for a comparable pricing with a lender credit of $866, you would probably have like a 7.125 or a 7.25 interest rate. So the rate is going to be higher. Obviously, that's where some of this money is coming from these DPA programs, right? You're not going to get something for nothing, unfortunately, in these cases. But you will notice $866 lender credit as well as 3.5% DPA. So, and no out-of-pocket broker fee for this transaction. Now we have a repayable option, right? Same 3.5% down payment minimum, which is the minimum down payment for an FHA loan. The rate is about 0.75% lower than the forgivable option at the same cost. And the assistance is provided in the form of a second mortgage at a rate of 9.99%. The amortization is 30 years. However, here is the super important point that you need to convey to the borrower in these cases. It is a balloon loan where after 10 years, the loan is due. So they would either, at that point, maybe have refinanced out of the deal, or maybe they would have already sold the property, or if they still have that loan, you're going to have to refinance that loan unless maybe they have the money to pay whatever is left. They would have amortized some after 10 years, amortized some of that loan, but they're either going to have to pay it out of pocket, or you can refinance the first and the second, which I would imagine, I would hope that the rate would be higher than the 7.5% rate that we have here at that time. So you would have another transaction under your belt with that borrower. Maybe they would want to do a cash out. You never know. A lot of things could be possible at that point in time if they still had that second mortgage, depending on the current interest rate environment. But here you will note that the rate is 7.5% with the same $866 lender credit for this repayable option. Now, you may ask yourself, why would a borrower choose a repayable option versus a forgivable option if they basically have the same cost? And the reason would probably be in the rate and in being able to qualify for the home, right? Because there is a difference in payment of a couple $100. Here in this example, our forgivable option, and this is just principal and interest on this loan, no taxes, insurance, or mortgage insurance. So you're looking at $33.19 for the payment on the forgivable option, and you're looking for $3,089 for the payment in the other option, in the repayable option. Now, there is $141 a month payment, so you have to factor that in. So the net really is not going to be, the almost $240, but it's still a lower overall payment, and that could be what puts them over the edge, because there is a maximum 50% DTI on these programs. If you're a first-time home buyer on these programs, it's a maximum 43% DTI unless the borrower completes a home buyer counseling course, in which case then they would be able to benefit from the maximum 50% DTI. So now we have a couple of additional twists here on this program, because now we have a closing cost assistance option for this same program. Now, the closing cost assistance option does require a minimum 660 credit score, just like the repayable option. The forgivable option is 620. However, the rate is a little lower. Again, 7.25% is the rate, but now you will see that the cost is higher, right? Where there is not a lender credit option available for this program. This one does have a cost on it, $3,610. So it's about 0.8 points more or less for this option. So again, you're looking at, why would the borrower choose this? I'm sure some of that is going to have to do with the rate and with their being able to qualify for the property, and possibly wanting to have a little bit less amount on that second mortgage, which is at 9.99 and does have a term of 10 years. So this is 3% assistance total. So roughly $13,000 and change here. $13,500 is the assistance. Now, our 4% closing cost assistance option has a little bit higher cost as well, $5,819. But you do have $17,370 in closing cost assistance. Uh, at a 7.25% rate. Now, one thing I did want to note about the closing cost assistance option versus the down payment assistance option is that there is a minimum 3.5% minimum borrower contribution required, right? And in any of these programs, you cannot have an overage that will go back to the borrower, right? That's just not possible. So they can't be walking away with money from the transaction here unless it happened to be extra escrow deposit that the borrower put, and then that money could be reimbursed to them. But other than that, they cannot use these programs to like have money available to do other things to the home that they wanted to do. That's just not the purpose of these programs. And then we have a 5% closing cost assistance. That's $21,712.50. Now, this is going to be really good for borrowers that are purchasing in higher cost areas where the insurance cost is higher and the taxes are higher. So you're going to have higher escrows, higher prepaid expenses, and on a $450,000 purchase, it's not out of the ordinary, to have $24,000, $25,000, $26,000 cash to close, maybe even a little bit higher. So this could be a very good option if you were in those high cost market. But you will note at the same 7.25% rate, now the cost is 85.81. So that's roughly like 1.9 points to get this option. So can get a little spendy, but if you want the full 5%, that's what it's going to cost. Now, one thing I did want to note about these programs, they do allow for manufactured homes, and most importantly for our house hackers out there, they do allow for a 2-unit property. Now, there is a loan level price adjustment for a manufactured home and a 2-unit property of 1 point. So any of these options that you saw on here, add that 1 point, which with our loan amount here of $434,250 would be $4,342.50 in additional cost to the loan to do a manufactured home or a 2-unit property, commonly known as a duplex. But that's very good to know. But what's most important to know is that you cannot, I repeat, you cannot use this program for a 3-unit triplex or a 4-unit quadplex. You cannot use it for a 3 or 4-unit property. They just don't, I would imagine they don't feel comfortable offering this type of a down payment assistance program to a property that could be seen so much more of an investment option rather than a primary residence, where we're trying to help the American family fulfill the American dream, right? So everybody dreams of owning a home, not being subject to the rigors of being a renter, especially in today's environment where rents are so rapidly rising. So this program is meant to help homeowners or future homeowners fulfill the dream of home ownership.
All right, great. I don't see any questions, so I think we can go ahead and wrap it up. Now, if you need help navigating any of these programs, you can contact us. You can visit us at themortgagecalculator.com, and we'd be happy to pair you up with one of our 340 loan officers all across the country that can navigate you through these different programs that we offer. We do this show every weekday at 11 a.m. Eastern time, where we go through the different rates and then we do a deep dive into a different topic like we did today with down payment assistance programs. That was great. So thank you, Jose. Thank you, Nick. Thank you, everyone, for tuning in. And we hope to see you on Monday, 11 a.m. Eastern, for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Have a great weekend, everyone.
Thanks, everybody.
Thank you, everybody. Have a great day.